Welcome everyone. Thanks again for joining us for the latest CreditorWatch Business Risk Index webinar, where we'll be looking at the September results. We've got a fantastic panel as always, joined by Anneke Thompson, who's the Chief Economist for CreditorWatch, who will be well known to most of you who've joined before. Anneke, great to have you on board. Thank you again. Looking forward to your insights as always. And of course, we've got James O'Donnell as well, Managing Director of Open Analytics. And ultimately the creator behind the Business Risk Index and the insights that come out. James, thanks for joining today.
Thank you, Pat. Great to be here as always.
So looking forward to getting into this. I can say without a shadow of bias that I think the Business Risk Index from CreditorWatch is the most sought after release on a monthly basis outside of the RBA's interest rate decisions. So I'm looking forward to getting into some of the numbers. September, we were just discussing earlier with James and Anneke. It is a funny month. I've always been a salesperson by trade, and I'm very, very acutely aware of how public holidays, school holidays, and short months can make a big difference when it comes to new deals being signed, revenue coming in, and whatnot. Was always a handy excuse when my sales manager would ask why I didn't hit my monthly number. So here we find ourselves with extra public holidays, a funny one that fell on a Thursday, so most people took Friday off. No shortage of excuses out there for salespeople, but no doubt James and Anneke will give us a much more raw version and look into it with actual data and insights rather than just utilizing gut feel, which I am an expert at. All right, let's keep moving along. Let me give you some key highlights, and we'll get into the experts. As you know, CreditorWatch is Australia's leading commercial bureau. We've got well over 55,000 companies using us to access a variety of tools from customer onboarding, credit reporting, credit ratings, analysis, and integration is always at the heart of what we do. So if you're looking to onboard clients in a better, more credit risk and effective way, please chat to us. Let us know that you want to be contacted and we can sort that out for you. Why are we different? Why are we so unique? It comes down to the data that we're able to capture from a variety of sources, 50 plus sources around Australia. 90% of the data that's coming in is unique to CreditorWatch. So you might be using another bureau, but you will not be getting the same insights that we provide. Not saying it's better, but it's definitely different at the very least. So I encourage you to contact us just to get a data test done, and we can show you exactly what additional insights we could be providing in the current economic climate. I think it is very important that creditors out there are considering how much data they've got access to, because really you can never have access to too much data. Enough of that though, on to the next one. So what have we seen from this particular business risk index this month? The risk of default over the next 12 months has increased in all regions across Australia that have 5,000 or more registered businesses within them. So thinking about those larger regions, not the small ones, with the exception of the Lower Hunter and Wyong regions in New South Wales. B2b Trade Receivable, so essentially that's turnover for small businesses, has been steady over the quarter to the end of September and is up significantly on January. So there's this continued increase and positive narrative coming out of the receivables increases, which is really positive. Small businesses are doing more business, which is good because they were absolutely hammered through COVID, as we know. However, as Anneke will talk about, and as everyone already knows, there are significant macroeconomic headwinds they're making it really difficult out there. External administrations dropped for a second month in a row. Sort of spoken about, seasonality of it. Probably not a surprise that it has come down, but still up significantly on last year, up 42% on January, and pretty much almost back to pre-COVID numbers. And James got a good slide for us midway through his presentation. And I think the other thing, court actions continue to rise, up 60% year on year. We know a lot of courts are obviously closed and backlogged. That's certainly back on track. The ATO will start to get more active, though that'll be slower as a result of the economy. And we know that the big banks are getting into their normal collection rhythms as well, but also they will likely taper that too. Some industry insights: receivables, as I've mentioned, continue to go up. The RBA, as we know, everyone hangs out for that first Tuesday of every month to see what they're going to do, and they slowed it down slightly with only a 25 BIP increase, which I think was more of a surprise than what the market expected. And then we've got monthly labour force, quarterly job data, showing that the unemployment rate has increased ever so slightly, and the number of jobs has actually decreased. So some good numbers coming out, plenty of negative numbers out there, and I think we're in for a wild ride for at least another 12 months or so. But let's see what inflation numbers look like as they come out. James, over to you.
Thanks, Patrick. That was a good oversight. So what I'll do is I'll dive a bit more into the detail of the data. So starting with our favourite chart, I think, the trade receivables. So this is small business data supplies from CreditorWatch, and we're looking at the average dollar trade receivables. So as Patrick mentioned, it's been a pretty flat month for receivables, sort of actually down a little bit. But I'd say with September, it's an interesting month. It's sort of a 30-day month with a public holiday. Of course, this year there's actually 2 public holidays because of the Queen's death. So there is a typical sort of seasonal pattern in sort of lower trade activity in September. So I wouldn't read too much into it. I think the general trend is still of sort of increasing B2b trade activity. A good other, same data but a different way to show it. This is basically the year-on-year change in small business trade receivables. And I like to think of this as our sort of measure of sort of GDP for small business. And you can see there that it's still sort of heading in the right direction. Credit inquiries. So again, what you tend to see is September is a bit of a slow month for credit inquiries. But again, it's the same sort of pattern that the general trend is still increasing, but sort of down a bit this month. So it's quite interesting, sort of, if you look in sort of consumer world, we do know through our work with the major banks that consumer credit applications are really down, particularly in things like mortgages. There may be some indirect effects there on business because within Australia there's a lot of sort of secured lending to businesses. Certainly not as direct as the effect on mortgages, but certainly there's probably some residual effects there on businesses as well. External administrations, I'd say don't get too excited about this. Month on month, you'd see a quarterly drop. That's sort of a usual sort of seasonal pattern. And again, I think it's sort of exacerbated this year with the extra public holiday. So less days in the months, less opportunities to lodge external admins. If you look sort of historically, we sort of highlight the quarter in blue there. You'll see you tend to see that sort of drop across the quarter. But the overall trend is still certainly going up. Trade payment defaults, another sort of flavour of sort of adverse outcomes for businesses. Big drop this month, but again, I'm not reading too much into that one, as the sort of overall trend, is still quite a significant increase over the last 6 to 12 months. Court actions, same again. So a bit of a drop this month, but I think it's the same story, that the overall trend is still heading in the same direction as insolvencies and defaults. So I think the best way to sort of roll that together is look at a rolling sort of 12-month default rates. So you can see we're well and truly past the bottoming out post-COVID. So we've been going up for 3-4 months now, and we've actually been tracking pretty closely to our forecasts. So our forecasts are pretty much in line with what we're seeing, but we're expecting that sort of average annualized sort of rate at which businesses fail to keep climbing. Interesting, we've been talking to a lot of the banks recently, and the general sort of consensus is they're expecting a fair bit of pain sort of early next year, and that's sort of in line with what we're forecasting too for business defaults. Okay, so they're probably the top level sort of indicators. So I think the summary there is a bit of a slowdown in trade activity and insolvencies for September, but the general trend is still on the increase for both. industry, probably no major changes this quarter or month. So this is sort of a relative look at average PDs or probabilities of defaults by industry. So no change at all in the ordering here. So the sort of food and beverage is still sort of at the highest risk end. And I'd say that sort of gap had opened up a fair bit. It seems to have stabilised there. So the relative difference between essentially hospitality and other businesses, it looks to have stabilised. And then sort of at the other end of the scale, it's the same sort of good news stories around sort of agribusiness, manufacturing, and of course healthcare as well. Payment arrears. Now this is our payment arrears from our small business data suppliers. We're looking at sort of the rates of 60-day arrears. So again, the average is around 10% for the industry. Now this is for small payments to small businesses. Construction is sort of sitting up there, sort of at the slowest payers again. I will say construction. I mean, we've had a lot of headlines around construction over the last few months. We are seeing the default rates go up, but they're not at this point. They're still not the actual default rates, and not sort of climbing at a rate any faster than the national average. But we're still obviously keeping a close eye on that industry. Okay, so then into the sort of regional view around the business risk index. So this is a bit of fun. We like to sort of recap of what the business risk index is. We basically measure the relative risk of regions. So we break the country down into about 350 regions. We're essentially credit rating the region and looking at a probability of default, and we sort of rank them, basically rank order the country. This is the best and worst performing large population centres. So I'll start with the good news stories. So we filtered the population here for regions that have at least 5,000 credit active businesses. So these tend to be sort of high population areas. So the lowest risk regions, a lot of them in sort of Victoria and South Australia. So you've got sort of the Yarra Ranges, so nice sort of wine country. Adelaide City is sort of continuing to be the lowest risk major city centre. Then if you look at the bottom of the table, look at sort of the biggest sort of population areas, the inner city sort of CBDs. There is a bit of a change there. That Brisbane's sort of gone down to the bottom, but it's the same story that the Eastern Seaboard CBDs are still really struggling. So they're the sort of the good performers, and then I'll finish with the worst performers. And again, it's still the good news here is that these regions we've talked about for a while, essentially Western Sydney and the Gold Coast and surrounding areas, they're not deteriorating any further, but they're still sort of sitting down at the bottom of the list in terms of the highest rates of sort of business insolvencies. So yeah, I think that's pretty much it from me. So I might hand over to Anneke to look at a bit more at the big picture.
And thanks for that, James. Anneke, I might just jump in before you start and just let everyone know, please do ask questions along the way. I forgot to mention that at the beginning, and we'll have some time for some Q&A at the end. So if you've got any questions, you can submit them in the GoToWebinar control panel. So thanks for that, James. Anneke, over to you.
Thanks, everyone. So I just wanted to start off with some a bit of a discussion on global risk. While that data shows we're sitting, quite nicely here in Australia, there obviously is an increase in insolvencies and defaults, but still relatively low by historical standards in Australia. But it is worth recognising that the global outlook is deteriorating, and even in the last couple of weeks, quite quickly. And we've got some big meetings coming up with some of the global heads of central banks and global finance ministers. So we'll get a few more insights over the next week or so. But I just put up some of the bigger economies that we do trade with, and the global perspective as well. So our outlook in Australia has declined, or our GDP forecast for 2023 has declined since April. But again, sitting relatively in a relatively good position compared to some other major economies, like the US and the UK, where central banks are having to go much harder to fight inflation in those countries. So, the risk of recession in the UK is, it would be getting up to sort of 90% now. USA probably in the 60, 70% now, whereas a couple of months ago it was probably more like 40, 50%. So some of the reasons for that is obviously the ongoing war. There doesn't seem to be an end game in sight at the moment, and they were even talking about risk of nuclear action in Ukraine, which would be obviously devastating from a humanitarian perspective, but just with my economist hat on, terrible for the global economy, because it would suck a lot of global players into that war. So that is a serious risk now. It's not something I ever thought I'd be saying, in January 2022. So it's something to be aware of. Inflation is still proving sticky, and the reasons though have changed. While a lot of commodity prices have dropped, shipping prices have dropped. Locally, food and beverage prices are getting back to more normal levels as our rural sector had more normal weather conditions for a while. There now is issues with currency. So the US dollar being very strong is exporting inflation everywhere, and that will affect us in Australia. No matter what our RBA do, the goods we buy from overseas will become more expensive if they're denominated in US dollars. So that is another issue for us. And then the interest rates. So obviously you're all aware that interest rates have risen. Don't need to tell this audience that, but it's likely the effect won't be felt until maybe the Christmas period. I'll be really interested to see how retail trade performs then, but also into 2023 when most people will actually feel the effects when the fixed rates come off. So they will hammer borrowers in 2023, not just in Australia, but globally. And then looking more locally, so NAB business conditions and Westpac consumer confidence came out this week. Still showing the same trends as they had over the last few months, which is that businesses are very confident, but consumers are not. And I think businesses are confident. I mean, you're all sitting in businesses yourself. There's demand conditions are still really good, despite the rising costs, the lack of labour, the rising interest rates. Consumers are still buying, businesses are still trading amongst each other. But I do wonder, consumers on a last sort of hurrah type spending spree, and again, look to December trade period to really see what comes out of that. And there's only very early signs that businesses are feeling the interest rate rises. But in Australia, at least, we had a long period where businesses didn't put prices up because of COVID, and we were in a very low inflationary environment for a very long time prior to COVID. So even though costs have risen for most of our businesses, they've been able to pass those on to the consumers, and consumers at present have accepted them quite readily. But there will be a ceiling for that. There's only so many price rises businesses can utilise before consumers start turning away. So we're still in an era, in a time where consumers are accepting those price rises, but that will end. And again, as I said, consumers are still very pessimistic for the outlook, at least. But again, looking at it in context and why Australian businesses are so confident given everything that's happened around the world. So it's important to note where our consumer confidence index is low, and it's very low by historic standards in Australia. It's nothing compared to overseas. So you look at that consumer confidence, that red line in the United Kingdom. If I was a business there trying to plan my budget or my revenue for 2023, that would be a very, very hard task at the moment with interest rates where they are. The mortgage industry is in a complete flux because I don't know where interest rates are going to go anymore, and consumers very pessimistic. So Australia is performing relatively well, and again with inflation, we talk about it a lot here, and it is bad in Australia. Don't get me wrong, but we have less pressures in Australia than we do overseas. So I think a lot of Australian businesses, and I think Patrick has said this before, are very well run, and a lot of very intelligent people running businesses, and they do see that whilst there are challenges in Australia, compared to the globe, we are doing reasonably well, and there are reasons to be confident in 2023, although obviously reasons to be very cautious as well. And then just a final sort of outlook slide. It's sort of summarising, the BRI data that we've just gone through and some of the global conditions. It's probably worth mentioning that jobs data again, which I think is pretty important and sort of flew under the radar, didn't get a lot of news, but our unemployment rate did move ever so slightly upwards, and the job vacancy data, which is a real forward indicator of unemployment, that has decreased for the first time in quite a while. So that says to me that businesses have sort of reached the peak of their hiring frenzy, and or they've started to be able to fill jobs through more migration coming into the country. So that will take some pressure off wages. But on the flip side, if we take pressure off wages, it reduces purchasing power of consumers. So as always, there's good and bad way to analyse the data, but I would really be watching that labour force going forward, because as soon as we start to see more unemployed people, I think that's when consumer spending will really start to fall off. That's my summary, so I might hand back to Patrick to handle questions.
Thank you. As always, that was great. I've got a couple of questions that have come through, and a couple from myself as well. Can you just explain sticky inflation? We've obviously heard inflation used to be the only sort of word for it, and over the last sort of 6 months, I think people have been introduced to transitory and sticky and et cetera, et cetera. So can you just explain sticky inflation for me and for anyone else who wants to understand what that means?
Yeah, so like transitory inflation is those price rises are caused by some shock. So the fruit and vegetable prices are a good example. It was weather conditions, particularly up north, that caused those prices to spike. But as you know, in your weekly or daily shop, those prices have come down. So we did have some transitory inflation in Australia. The sticky stuff though is where price rises beget price rises. So those tend to be products that have a lot of inputs. So it might be that all the prices in that product are going up, and so you get these continual movement in the end cost of that good, and that won't stop until the prices of all the goods stop. But when we're buying things from all over the globe, we've got to accept the prices that come from around the globe, and that's where the sticky sort of inflation hits. And on the currency side, I said if we're buying things denominated in US dollars, and our currency is weak versus the US dollar, the price of that good is going to go up. So that's where the RBA doesn't really have much control over goods that are produced overseas in another currency.
Yeah, fantastic. Thank you. And given where we're at in the year, middle of October, big sales starting to come up, Black Friday and the big online sales, which I heard the other day from Paul Zara, who's the head of the Australian Retail Association, that is now as big as the Boxing Day sales. How do they look at that obvious increase? Is that looked at it from a seasonality perspective compared to previous years when they're assessing inflation and then obviously interest rate increases?
Yeah, well, the retail trade data is usually compared to the same time as last year, although even those charts look very odd now with COVID over the last 2 years, so it's not a nice smooth line that we used to get. But yeah, look, you always look at retail trade data with a seasonal lens, I guess, on it. But we could, it's consumer behaviour is really, it's a whole subset of economics and behavioural science. And it might be that consumers expecting inflation to stay high causes retail trade in those Black Friday sales periods to be quite high, because it might be consumers saying, well, I'll buy now because next year it's going to be more expensive. So it's very hard to work out how inflation makes consumers behave, and particularly when you've got the expectation of inflation, in consumers' minds, it can make looking at sort of raw data quite tricky, for us data people out there.
Yeah, that's it. Thank you. James, a question that's come in, and I can confirm this, but I'll get you to confirm it, was the ACT obviously considered in the regional analysis? So the answer there is yes, but So you can actually jump onto CreditorWatch, look at go to the News Hub, and then Business Risk Index, and you can scroll and have a look at the ACT as a territory versus the other states and territories, but also have a look at the individual regions in there. Did you want to? Is there anything worth noting about that region?
Yeah, I'd say the ACT is quite low risk. And so if you compare it to the other major centres, it's actually, it's smaller populations, but I think maybe the government bubble there, that even through COVID, Canberra, ACT fared pretty well.
Yeah, nice. I was just having a little flick through, and it's sort of middle of the pack, which is good. Question that comes up all the time: where are insolvencies going? How far above do we sort of expect them to go above pre-COVID levels?
Yeah, I'd think roughly about 20% higher is what our current forecasts are predicting. I'd say that there's some downside risk there. So if inflation really remains sticky, then those numbers could be a bit worse. But there's no indicators that are really indicating very large spikes in insolvencies, but they're just steadily increasing. Yeah,
good to know. And it will be certainly interesting to see how the year finishes off, and then how it starts again. But as you both mentioned, I think Aussie business owners and managers and whatnot are generally feeling like a downturn can't be as bad as a lockdown. So hoping that certainly continues. We know that there's I like that as well, James. I think that we'll see that resilience continue within the Australian economy, which is really good and really positive. There's still a positivity out there. People want to get on with it, keep doing business. Naturally, there's going to be that increase in insolvencies, like you mentioned, James. But there's also a big part of those are businesses that actually never opened back up, and you only have to walk around, the CBD or the outskirts of the CBD to see a lot of retail stores and smaller cafes and restaurants that never opened back up. And while it's obviously horrible to see that, the fact that they're essentially being washed through the insolvency system is almost a sort of tick box, and it's unlikely that they're racking up or continuing to rack up debts while they're closed, of course. So hopefully that has less of a domino effect, network effect on other businesses, that when they do go under, it's not a shock to other creditors, and they've either probably written that off or have minimised the exposure to those organisations. All right, that's it for questions. Thank you both very much. A huge amount of work goes into this. I know it always looks hopefully it looks very smooth for everyone who's signed in and watching. But James and Anneke put in a huge amount of effort to get these slides together, as did the marketing team. It doesn't just happen automatically. So a big thank you to you both. Thank you, James. Thank you, Anneke. Always great to have you on. And thank you everyone at home listening in, or at the office, hopefully back in the office and helping stimulate the economy. We will see you next month. Keep an eye out for future webinars. Of course, we do the Business Risk Index every month, but there's plenty of others coming up over the course of the rest of the year. If you want to delve deeper into the information, jump onto CreditorWatch, click on News Hub, and follow the prompts through there. And I've always got one last poll for those who are interested. Do you wish to be contacted by a CreditorWatch staff member after this webinar? Please let us know. Don't be afraid to say no. We are thick-skinned here at CreditorWatch, but that way we can obviously tailor our response as quickly as possible to those that want to be contacted. If you're just after more information, please go to creditorwatch.com.au. There's no shortage of information about product, data, and of course the News Hub and the blog has got a wonderful array of information and articles to assist business owners, credit managers, people in finance, anyone and everyone. All right, I will close that down. Everyone was very, very honest there. 95% of you saying no. Thank you for that. Final goodbyes, James, Anneke. Have a great week. Chat to everyone very soon.
Thanks.
Bye.
Thanks, everyone.
Thanks, everyone.